market valuations, tariffs, seasonality. These are uncertain times. And today I'm going to talk about an action plan with 3 sectors you guys should concentrate in these uncertain times. My name is Keith Richards. I'm President, Chief Portfolio Manager, and Technical Analyst, ValueTrend Wealth Management. And this is the Smart Money, Dumb Money show. And you guys, because you're watching this show, are smart money. So let's get started. Well, to start off, I'm going to give you the 3 areas that I want to focus on as our action plan right off the front. No holding back here, guys. We're going to talk about going global as number 1 step, hard assets, which you guys have heard me talk a lot about over the past year, and finally, staying defensive and what that means. So we'll be covering these at the end of the show and the specific sectors I want you to look at. But for now, I just want to give you an idea of where we are on the markets. So what we're looking at here is the composite index by the Conference Board Business Cycle Indicators website. And by the way, you guys can Google this for yourselves. And it uses 10 leading indicators. So that composite Conference Board uses leading, coincident, and lagging indicators to tell what the economy is doing. I like the leading indicators. So this is a composite of those 10 indicators. Now, I'm just going to read off to you some of those indicators that make up this 10-point composite. So we'll start off with the average weekly work hours in manufacturing. It looks at factory orders. It looks at housing permits. It looks at stock prices. It looks at the index of consumer expectations. And by the way, you guys have probably seen me post some of these charts individually in the past. This is a composite of them all. Just to finish up, weekly claims for unemployment insurance. And finally, the interest rate spread. So all of these are leading indicators for recession coming your way. And now I want you to look at a chart that I've posted, courtesy of Rosenberg Research. And you can see that when the leading indicators dip aggressively, such as 1970, 75, 1980, 1990, 2000, 2009, and son of a gun, what's happening right now, pretty deep actually, 2025. These are considered recessionary times. The dark lines here that are outlined on the chart are actual recessionary times. So the leading indicators, they tend to start to decline coming into that recession. So you can see this decline was coming into the recession of 1980. This decline was coming into the recession of 2009, etc. So we are now starting to see leading indicators tell us there is a recession coming to North American markets. Now I'm going to now apply these years that we just looked at when that composite fell to extreme lows to the S&P 500. And by the way, the same data applies to the TSX, so I should say the Canadian economy. In fact, both Canada and the United States are around 30% probability of recession in the coming number of months, according to the statistics that I've been reading. We're fairly matched. So S&P 500, what did it do during those periods of time when the composite leading indicators were saying the recession possibility and then an actual recession happened? Well, let's take a look. Early 70s, definitely a recession. The mid 70s, you remember that one on the chart we just looked at? Market pullback and recession. 80, do you remember it was falling in 1980? Well, 81, etc., market fell. Now, the only time these indicators pulled back hard and the markets did not get pushed down was during the 90s, which is interesting. But I was a new broker back then, and I do recall that it was kind of the birth of the mutual funds and all kinds of retail investors who had generally not been in the market before 1990 began coming into the market with their money buying these mutual funds at the time, and that probably drove the market despite of the economy being a little weaker. Anyways, carrying on, we know that the chart we looked at a minute ago, 2000, was a leading indicator for recession. We did see a recession. The market fell like a brick. So did 2009, which was another signal. And here we are today. So the question is, are we heading into recession, and will the markets decline as they have in all but one example since the 1980s? That's the question of the day. Okay, as I mentioned a minute ago, my 3 strategies for these uncertain times, including the probability of recession, are going global, holding hard assets, and buying defensive assets. So we're going to start off with global assets. And on one of my very recent videos, I presented this chart. This is the iShares MSCI Index ex-US. So it takes the US market out. And what you can see is that it's been a rocket. Now, everybody knows the S&P's risen, but the S&P has risen only about 7% over its previous resistance level, whereas the world markets have dramatically risen through that level. So the world markets, including Canada, have been the better place to be. So maybe I've convinced you that you should hold some international assets in your portfolio. Well, there's kind of 2 broad categories of international assets, and that's developed nations, of which Canada is one, and then there's emerging nations. So I'm not going to give you all the charts because it would take you an hour of watching this video for me to go through every chart of every market in the world. So I'm just going to kind of give you some of the markets that I like. So within the developed nations, I like Japan. And you can see on this chart, in fact, we own this ETF, the EWJ, which is the iShares Japan. It recently broke out. In fact, if you watch my recent BNN episode, Bloomberg BNN, I put this as one of my top picks. Why? Because Japan broke out. It's consolidating in the near term, but I really like the look of Japan, the Japanese economy right now. And I also think the fact that they got through the tariff negotiations, it's one and done, they can move on, and we can probably expect some relief rally on their markets. The next thing is Europe. Now, everybody knows Europe has been doing very, very well. And as you can see on this chart, they've absolutely, without question, outperformed the S&P 500. I think this market has still got legs. It'll probably take a pause, but I do think that Europe is a place we should be looking. Now, within the emerging markets, you can always buy an emerging markets ETF. In fact, ValueTrend has one emerging markets ETF, but we've also got a number of individual countries ETFs that fall within that emerging markets sphere. And so I'm just going to put a couple up right now that I like. One of them is India. Now, this is not the ETF that we own, but this is the this is the iShares India ETF. And what I like about this is it fell like a brick, made a nice base, and is just now struggling to break its neckline. And if this breaks out, I think you're going to see a strong move back to the old highs and higher, because India also has been one of the countries that has negotiated its tariffs. It's kind of one and done on that stuff. So I think India can carry forward. In fact, from what I understand, the deal that India did with the US was actually pretty good for them. Now, the other one I like is China. Now, I don't own any direct China, but because I do own an ETF that represents the emerging markets, and China is about 35% of that particular ETF, we do have a chunk. You can't argue with this chart. So it's done a nice base, it's broken out, and it's in an uptrend. I think China, buy on any dip, because they're in the midst of finalizing a deal. In fact, I just read the other day that the deadline for their deal is August 12th, so it's not that far away. And I think something good is going to come out of it. I've talked about this on past videos before, but the bottom line with China is that of all the countries in the world, China has something that the US can't do on its own, and that is rare earth. So keep an eye on China. Okay, number 2 of my 3-part strategy is hard assets. Now, at the potential of boring you guys to tears, because I have repeated this ad nauseum for probably well over a year now. It's been probably a year and a half that I have been talking about buying hard assets. And I've been right. You guys know most of the hard assets have done quite well. In particular, gold, silver, and even copper's had a bid lately. So I'm going to just go through some hard assets that I like today. This is by no means the only ones. And I'm going to give you a new position that we've been buying. So, because you guys already know that I've been buying nat gas and copper and gold. So I thought I'd look at a couple other things. But just to start, we'll take a look at the commodity index. And you can see this is the CRB spot commodity index. It's going up. As I always say on BNN, by the way, when I'm talking to people that phone in with my questions, I always start off by saying, up is good, down is bad. So this is up, and we like that. In fact, it's done a nice little breakout, and I think the commodity index, from a longer term perspective, if you've watched some of my older videos, has many years to come for outperformance. So just to review a couple of specific hard assets, again, you guys know that I like a number of them, but I want to just do a quick review of natural gas because I have been talking a lot about that lately. In fact, I encourage you to click below and go to the day in the life video. It's called Day in the Life for Portfolio Managers, and Craig and I did a video together, and we talked about what kind of natural gas producers we are buying. You should take a look at that video. It's quite informative. But when we look at natural gas, you know, it's attempting to break its neckline. It's still consolidating, but what I like about this formation is the lowers are not getting lower. It's forming a little bit of a triangle, and eventually I expect that natural gas will break out because, as we talk about in our Day in the Life of Portfolio Managers, there's a lot of demand coming out of Europe, and actually nat gas prices are high in Europe. So, you know, selling that product into Europe, and Canada's a major candidate to do so, will be very, very profitable for gas producers and eventually push nat gas prices up altogether. So this is just the nat gas price, but I could suggest that it's got, you know, 50% plus upside if that breakout happens. Now, the next thing I want you to pay attention to is oil, which we have completely eliminated out of our value trend strategy for now. Why? Because it is in a downtrend. Now, it had a nice little spike when Iran was bombed, but basically oil does not look good to us right now, whereas oil, or I should say nat gas, as you can see on the other side here, is moving up. So remember, up is good, down is bad. Just to briefly touch on a couple of other commodities you guys know that I've been beating to death for more than a year. Gold, what's not to like about this chart? It is consolidating, but I think gold will break out of that consolidation and move up. The only caveat to that is I have talked about potential strength in the US dollar because it's so oversold. If the US dollar moves up more than a couple of pennies to the upside from where it is right now, you may see gold continue to weaken. However, I don't think that the US dollar is going to zoom anytime soon, pardon the rhyme, but it is something to keep an eye on. Nevertheless, you don't argue with this trend. Now, the other metals that I like is the base metals. You guys may be aware, I've talked about this before. Copper has had a nice move lately. It's a rough uptrend, but more of what we call a triangle. That's a consolidation pattern within technical analysis, and eventually consolidations break out. I do think that base metals, based on all the research we've done fundamentally at ValueTrend, including the need of copper and aluminum and other such metals through the development of AI and robotics, the stuff that I've shown in past videos, the demand for these metals is going to go up by a significant level over the coming 5 to 10 years. So we are believers both fundamentally and technically in the base metal play. Final hard asset I want to talk about are a couple of maybe overlooked assets. A new one that I haven't talked about on this show is agricultural nitrates and potash. And we just began taking positions in a couple of them. There's really only 2 of them out there. We own them both. One of them is Mosaic, and you can see massive downtrend right into a couple of few months ago, and then boom, and it's off to the races. Sure, after a parabolic move like this, you're going to get a consolidation, and that's what we're getting, but we see tons of upside. The need for food as population expands, and nitrates are the only way to meet those food demands. Now, the next thing I want to talk about is something I have talked about before, which is rare earth elements. As I mentioned before, China has the market there. They're 80% of rare earth element production. And this is all about AI, robotics, electric cars, all that stuff. So this stuff is in demand. It's making a nice breakout after that downtrend. I think there's tons of upside on rare earth. You have to be patient. It's not a low volatility trade, but I think it's something that we want to hold at least a piece of in our portfolios for diversification. Final strategy of my 3-point strategy for dealing in today's uncertain times is defensive stocks. And I want to start off by talking about where we are in the economic cycle. I want you to pay attention to this blue line here, because the orange line is really just a tail from the end of this blue line. So we are right now somewhere coming into early recession, as you can see on this chart. So we're coming into early recession. I'll zoom in a little bit, and typically it's the defensive. So don't pay attention to the bottom here. It's the blue line coincides with the upper sectors, and typically as we move into recession, we move from consumer staples to utilities and even real estate, believe it or not, because real estate prices eventually become depressed. You'll notice it's on the right-hand side of the chart because we're not there yet, but we are seeing real estate prices sell off right now, aren't we? Well, eventually they become attractive. At this point, it's really kind of consumer staple, utilities, stuff like that. So that's where we are in the cycle, and why I believe we should be looking at, within our portfolio, defensive stocks. On top of our focus on these defensive stocks, I think we should focus on the Canadian defensive stocks. Why is that? Well, I believe that, number one, the Canadian counterparts are a little cheaper when you look at it compared to the US counterparts, because a lot of investors, for example, within the utility space have already recognized the need for power in AI generation, and I think the Canadian market's just catching up. Number two is these stocks that I'm going to talk about now, these sectors often pay very, very high dividends, and you want to get that dividend tax credit, so you might as well buy the Canadian side. So this is the iShares utilities sector, and you can see it's just breaking out from its old highs from back in 22. It is a little parabolic. I would expect it to pull back, but this is a good looking chart. It's also in the right sector for a soft economy. So we want to take a look at buying this sector if, as and when it pulls back a little bit. Same thing with REITs. Now, we're in REITs at ValueTrend, and we actually own this particular ETF. We also own two other separate individual REIT stocks. I talked about them on my BNN show. You can go back to that, but I'm just going to look at the sector itself today. You can see massive support that it's bounced off so many times. It's recently bounced off. Likelihood is the REIT sector will come into some resistance pretty soon. That lands somewhere around, let's call it $11 or so on the XRE ETF, which again, I disclose we own. That's a few bucks ahead of now, but in the meantime, you own a nice dividend. You're in a defensive sector for the summer and during these uncertain times. So I think it's a good place to have a piece of one's assets. The final two things I'll talk about from a defensive point of view are looking at value stocks and consumer staples. Now, you'll remember on the economic cycle chart I showed you a few minutes ago that the economic cycle suggests that we buy consumer staples. So we'll look at that chart to start with. That's on the right-hand side here. You can see that despite the fact that the S&P is broken out, consumer staples are contained. Why? That's because it's been all about growth, all about AI and all these aggressive growth stocks. But as the economy softens, the market will start to pay more attention to staples and utilities and value stocks and that kind of thing that we've been discussing here. So it would not surprise me if we saw a breakout by the staples. And by the way, a study done by Brooke Thackeray, who produces the Thackeray investment guides, he has shown that if you rotate into consumer staples during the summer, they tend to outperform consumer discretionaries. He's got a lot of research on that. I encourage you to read his books. So what I'm going to suggest is that if we see this consolidation, which kind of looks like a triangle to me, breaks out on the staples, you'll probably see a strong move. And this time of the year is tending to be the time that it does happen. So keep an eye on consumer staples. The other thing I want to talk about is value stocks. Value stocks tend to do better when the market softens because the focus gets off of the growth stocks and retreats into a more safe orientated sector like value. IVE is the ticker for the US iShares value ETF, and it's a pretty good indicator of how value is doing versus the growth stocks, which they also have a growth stock ETF you can track against. And you can see that the value stocks have not kept up with the S&P, but are just now breaking the neckline. So my thoughts are next stop at the old highs, and then if the markets do in fact weaken, you may actually see the value stocks start to step up. So I hope that helps. Remember, if we go into a soft economy and with all the noise surrounding tariffs and the summer doldrums on the markets and all that stuff right now, we want to keep our focus on global assets, hard assets, and defensive stocks, including some cash. So keep these in mind as we move forward for the second half of the year, because I don't think we're in Kansas anymore, Dorothy, so we got to be cautious, more so than we've been in the past. Thanks for watching, and we'll catch you next time. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years, and in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.